Hey everybody, Dr. Phil here. This is a video on cash, fraud, and internal control. So what is internal control? So the definition that you're going to find, generally speaking, is a system of internal control is used to monitor and control business activities. It includes the policies and procedures used to protect assets, ensure reliable accounting, uphold company policies, and promote efficient operations. Now, critical to internal control, and a big change to internal control, was this act that was passed in the early 2000s, Sarbanes-Oxley, which we typically abbreviate SOX. So this requires managers and auditors of public companies to document and certify the system of internal controls. So the requirements include that the company must have effective internal controls. The auditors must evaluate the internal controls. We're talking about the external auditors. The violators receive harsh penalties up to 25 years in prison with fines, and the auditor's work is overseen by what we call the Public Company Accounting Oversight Board, or sometimes I just call them the peekaboo. So principles of internal control. So internal control principles that are common to all companies, regardless of what business or industry you're in. Responsibilities have to be established. Adequate records have to be maintained. Insuring assets and bonding key employees. Bonding just means basically taking out an insurance policy on them. Separate record keeping from custody of assets is certainly important. Divide the responsibility for related transactions and apply technological controls. So think about the IT systems of these companies and their, IT infrastructure, and perform regular and independent reviews. So let's talk a little bit more about establishing responsibilities. So number one, tasks should be clearly established. So people should know, what am I required to do versus not, so on and so forth. Tasks should be assigned to one person. If you assign it to a group, there's less chance it gets done. And then you can figure out if there is a problem, who is, in essence, to blame. So what about maintaining adequate records? So by doing so, you're helping to protect your assets, helps managers monitor company activities, and it could include things such as detailed records, use of a chart of accounts, which most companies would be doing anyway, pre-printed forms, pre-numbered sales slips. Think about those numbers that they put on checks, for example, just to kind of help you keep up with, what range you're in any one given period. And computerized point of sale systems. So think about, like, all these places you go and it's beeping. You're running your stuff across the scanner, if you will. It's keeping up with the inventory. All right, insuring assets and bonding key employees. So your assets should be, kind of goes without saying, right? Your assets should be insured against losses. Employees handling a lot of cash and other assets should be bonded in case it turns out they're committing fraud or embezzlement, defalcation, those types of things. And that way the company has a way to kind of get some of that money back if the employee isn't able to. So bonding means the company has purchased an insurance policy against theft by that employee. That's really all it means. All right, separate record keeping from custody of assets. So the person who controls or has access to assets must not have access to that asset's accounting records. So we're trying to keep the physical custody and the record keeping separate. It reduces the risk of theft or waste of an asset. And employees would need to collude, agree in secret, basically, to commit fraud under this control. So that's the only way they could really circumvent it, if you will. Divide responsibility for related transactions. So responsibility for a transaction should be divided between two or more individuals. You don't generally want one person having all that control. This ensures the work of one person acts as a check on the other to prevent fraud or errors, again, notwithstanding any collusion. And we call this separation of duties for obvious reasons. All right, apply technological controls. So number one, cash registers make an electronic file record of each sale, obviously. Time clock records the exact time employee works, and ID scanners limit access to authorized individuals. So that's not an exhaustive list, obviously, but these are some examples of technological controls that companies pretty much routinely apply. All right, perform regular and independent reviews. This helps ensure that procedures are followed. Think about performance appraisals, for example, preferably done by auditors, but not directly involved in the activities. So a lot of times this could be the external auditors, right? The PwCs, the EYs of the world. And auditors evaluate the efficiency and effectiveness of internal controls. So what are some limitations of internal control? Well, human error. We're human, right? We make mistakes. People are careless. They make misjudgments. They may be confused, not understand something. So that's more on the benevolent side. On the more malevolent side, excuse me, on the right, human fraud, intentionally defeating internal controls for personal gain. So think about things like theft, for example. We would be remiss here to not mention the fraud triangle. There are basically three elements on the triangle: opportunity, pressure, and rationalization. So we would say that pretty much, not always, but most times, all three of those components, those elements, are present when fraud is committed. And then the cost benefit constraint: the cost of internal controls must not exceed their benefit. So that's really something, maybe not in the context of internal control, but that's something that you all knew, right? You're in school, you understand the cost benefit constraint, right? The idea is that you're like, well, there are costs associated with going to school. There's hopefully a better benefit when I get out. All right, so what about control of cash? So an effective system of internal control that protects cash and cash equivalents should meet three basic guidelines. And just as a quick aside, cash equivalents, think about things like money market funds, share-term certificates, those types of things that are highly liquid and they're very easy to pull out should you need to, and short-term too. So handling cash is separate from record keeping for cash. So again, the custody and the record keeping are separate. Cash receipts are promptly deposited in a bank where, of course, it's FDIC insured up to a certain amount. And cash payments are made by check or EFT. You certainly shouldn't be making any payments with just actual cash. So cash and similar assets are called liquid assets because they can be readily used to pay liabilities. So when we talk about liquidity, we're talking about nearness to cash, right? Like how easily can you turn something into cash? So we would define cash as currency, coins, and deposits in bank accounts. Also includes things like customer checks, cashier's checks, certified checks, sometimes called bank checks, and money orders. And as far as cash equivalents go, again, I kind of just touched on this, but we'll talk about it again real quick. Short-term, highly liquid investments that are, one, readily convertible to a known cash amount. So they're not really prone to things like interest rate changes, for example. And two, close to maturity date and not sensitive to changes. So what about cash management? So the goals of cash management are twofold. Number one, plan cash receipts to meet cash payments when due. And number two, keep a minimum level of cash necessary to operate. So number one is really speaking to that liquidity. Got to make sure that we've got the money we need to pay our bills. And then number two is just making sure that most companies like to keep a minimum balance. Some banks may even require them to. Effective cash management involves applying the following cash management strategies. Number one, encourage collection of receivables. Number two, delay payment of liabilities. So think about money coming in, money going out. Keep only necessary assets. Don't waste money on things you don't need. Plan expenditures. Don't make them last minute. And then invest your excess cash. So over-the-counter cash receipts. So what we're seeing here is basically pictorially illustrating that none of the people involved can make a mistake or divert cash without the difference being revealed. Right? So the clerk rings up the cash sales on the register and prepares the cash count sheet, and of course keeps a copy for themselves, and sends to the company cashier along with the cash. So all the cash and the sheets are sent over from sales to the cashier's department, and then the supervisor reads the register data, prepares the register sheet, also keeps a copy, and sends both to company cashier. So this is a good example of, not that it would be impossible to commit fraud, but it would be much harder because of the way this is being set up. Okay, next thing we should talk about: cash over and short. Well, the first thing we'll talk about is the overage. So sometimes errors in making change are discovered from differences between the cash in a cash register and the record of the amount of cash receipts. If a cash register's record shows 550, but the count of cash in the register is 555, we would prepare the following journal entry. So we would debit cash. We're going to increase cash by 555 because that's the actual amount in the register. We're going to increase sales by 550 because there's only a record of 550's worth of sales. And then what we'll do is we'll credit this account cash over and short in the amount of $5 to make up for the difference. Now, what if there's a shortage? We just talked about overage. What if there's a shortage? So let's say that it shows 625, but the count of cash in the register is only 621. So obviously we're now $4 short. So what we would do here is, well, the first thing we'll do is we'll just record the cash we do have. We know that there's 621. So we could debit or increase the asset account cash for 621. We're going to increase sales by 625 because that's what the record shows. And then the difference, the 4, is going to be debited to cash over and short. So really easy way to remember this: if it's an overage, like in the last example, like here, it's going to be a credit to cash over and short. If it's a shortage, it's going to be a debit to cash over and short. So what about cash receipts by mail? So two people are assigned the task of opening the mail. The cashier deposits the cash in a bank, and the record keeper records amounts received in the accounting record. So we use two people here, or the company uses two people here. So again, it's much harder for one person to, get away with any kind of theft. So control of cash payments. So this is important as most large thefts are from payment of fictitious invoices. So the keys to controlling cash payments: require all payments to be made by check, no actual, cold hard cash, and limit access to accounting records except for those who have the authority to sign checks. And as far as the cash budget goes, you should certainly be including projected cash receipts and cash payments. All right, the voucher system of control. So a voucher system, this is going to establish procedures for verifying, approving, and recording liabilities for eventual cash payments, and also for issuing checks for payment of verified, approved, and recorded liabilities. So it's very much a system of making sure that all the correct authentications, correct procedures have been followed before money leaves the building, leaves the company, however you want to say that. So here you can kind of see the voucher, and you can see, all these different people that are involved. There's a purchase requisition, there's a purchase order, there's an invoice, right? There's a receiving report whenever whatever order shows up, invoice approval, when a check gets sent out. So all of these, they're being checked for, like the dates are correct, the amounts, the quantities, all these things should match all the way through this voucher system. Okay, petty cash system of control. So petty cash, you may have heard the term. It's just most businesses keep petty cash just for small things. Some examples here: shipping fees, minor repairs, low-cost supplies. So if you want to establish a petty cash fund, it's fairly easy to do. Then what we're going to do is we're going to debit petty cash and we're going to credit cash. So we're basically just moving it from the main cash account over to the petty cash account. In this case, we're moving $75. So here you see a summary of petty cash receipts. So this is basically, some of the things that they spent the money on. So we've got transport of merchandise purchased, $15. Purchase of office supplies immediately used, $4.75. They're just basically accounting for, right? If we go back, they put 75 into the fund. They're just saying, okay, well, we've used 71.30. These are the things that we used it on. What they're really looking for is a reimbursement from accounting. So here is the journal entry to reimburse the fund. So we would debit, all these are expenses, except for, inventory is being increased, because again, remember, it's the value of inventory. So that's a cost that can be added. We've got 3 expenses here from here. These are the 3 expenses. And then we are crediting cash, again, the main cash account, 71.30, which is being sent over to the petty cash fund. So it's basically just reimbursed back up to 75. So to increase, we're going to debit petty cash and credit cash. So if we, like, for example, if we wanted to increase the petty cash fund from 75 to 100, we would just debit or increase petty cash, 25, and then we would just credit cash. Think of the cash as the regular cash count by 25. And if you want to make it lower, you just do the opposite. So in this example, they want to take it from 75 to 55. no problem. Debit cash, the regular cash count, that's increasing that. And then credit to petty cash, which is decreasing that. All right, so if petty cashier fails to obtain a receipt for payments or overpays an amount, of course, cash over or short will result. Petty cash payments report plus cash left in account will not total to the fund balance, obviously, if something's been omitted. So if there's a shortage, the difference is debited to cash over and short, and if there is an overage, just kind of like before, same rules, it's the difference is credited to cash over and short. So you can see here, we have a debit, right? So obviously we know if it's a debit, look at your rules, it's a shortage. So they had miscellaneous expense 178. They were reimbursing 185, so it's basically probably a $7 receipt that somebody forgot to get or they got lost. So they're just going to debit the difference cash over and short. Deposit ticket. So this is probably something most of you are familiar with, just where you just go pay money into the bank. You would just list all your cash and checks along with the amounts, and then it just serves as your proof of deposit, right? So because you're going to get a receipt from the bank saying you paid in all this money. I think you all know what a check is, although admittedly people don't really write checks much anymore. I know we certainly don't. Used to withdraw money from the bank, obviously, includes maker, signer of check, payee, and payer. So all these have been labeled for you here. So we've got the maker, basically who owns the checkbook in essence, who's paying it. The payee is the person you're sending the money to. In this case, Hillcrest Lighting. The amount 375. The payer is basically your bank, like as if you were writing the check. And then you've got, in this case, you wouldn't always have this down here, certainly not on a personal check, but they've got a little area for describing. A bank statement, I think all of you know what a bank statement is. Most of us get them now, of course, electronically. So usually about once a month, the bank sends each depositor a bank statement showing the activity in the account. So you've got your description, is it a deposit, is it a withdrawal, and then you've just, of course, got a running balance along the right-hand side. So bank reconciliation, this may or may not be something you've heard of, is prepared periodically to explain the difference between cash reported on the bank statement and the cash balance on the company's books. So usually because of, there's a lot of transactions running through constantly, so it's always going to be different, right? So your bank statement's going to show you one thing, your actual bank's going to show you something different, and that's usually okay. So some of the bank balance adjustments we make, because remember, there's in essence two sets of books. There's what the bank says you got on the left, bank balance adjustments, and then what you say you've got. So the bank balance adjustments, we would add deposits in transit, take out any outstanding checks, and then add or subtract corrections of bank errors. And then for the book balance adjustments, we're going to add interest earned and unrecorded cash receipts. We're going to subtract bank fees and NSF checks. That's non-sufficient funds, NSF. And then add or subtract corrections of book errors. So the purpose of the bank reconciliation. So the balance of a checking account reported on the bank statement is rarely going to equal, as we were saying, rarely equals the balance in the depositor's accounting records. So we have the cash balance per the bank, plus deposits in transit, minus outstanding checks, and then plus or minus any bank errors will give us the adjusted cash balance. And then on our side, the right-hand side is our side, cash balance per our book, plus collections and interest, minus any bank fees and NSF checks, plus or minus any book errors will give us the adjusted cash balance. So the goal is that these two adjusted cash balances equal. So here's an example of bank reconciliation. So like we can see the bank statement balance. So the bank statement shows up, it says 2050. Our book balance says 1405. So okay, that's pretty good difference there. So let's make sure we can account for those differences. So we add there was a deposit of October 31st in transit. We can add that because the bank doesn't know about it yet. So we can add the 145. So we got 2195, and then we have two outstanding checks, one for 150, one for 200. So we take out the 350, and then we have an adjusted bank balance of 1845. On our side, on the book balance side, 1405, the bank collected a note. Basically, just think of it like a loan on our behalf, 485. We earned $8 of interest, so that was 493. We add the 493 to the 1405, we get 1898. We take out a check printing charge, pretty steep there, 23. NSF check of 30. So we've got a total of deductions of 53. And then we have an adjusted, also have, and that's your key, that's why it's highlighted in red, also have an adjusted balance, book balance of 1845. So they match. So that is the goal of the reconciliation, to make sure we can account for all of these differences. All right. So here are some entries from the bank reconciliation. So these are things that we basically just found out about. So remember we talked about the bank collected this note for 485. So we're going to debit cash. We're going to increase cash. We're going to credit or decrease notes receivable to remove that because it's been collected. For interest earned, we're going to debit cash and credit interest revenue. For check printing, we're going to debit just miscellaneous or printing expense. Miscellaneous expense is fine. Credit cash to remove that. And then we have an NSF check, non-sufficient funds. So what we're doing here is we're just basically saying, oh, we thought we'd got it, we didn't. So let's go ahead and add the account receivable back for 30, and then we're removing cash that we thought we had but we didn't. Okay, I think this is the last thing we have to talk about in this video. Day sales uncollected. So this is a ratio. It indicates how much time is likely to pass before we receive cash payments from credit sales. So day sales uncollected equals accounts receivable divided by net sales and then multiplied by 365. So you can kind of see down here like some of the ratios. So these companies like Starbucks, 14.2 days, 10.2, 12.1. So not a huge amount of fluctuation. So Jack in the Box, 20, 23.9, 17.3. So again, just really saying how long is it taking them to collect their receivables. All right, thanks as always for watching, and I will see you all soon.